So one of the three circles that we look at is alpha and above market returns. And obviously every investor wants above market returns. For a long time, a lot of that was considered out of the realms of the average investor. And a lot of it was kind of looking at, hedge funds can deliver above market returns, private equity can deliver above market returns. Certainly, hedge funds have taken a bit of a nosedive in terms of their popularity. Private equity seems to have picked up the momentum, and yet with that, obviously, and I think the same thing happened with hedge funds. A lot of people went in and created hedge funds, and so any value gap that was there, you had too many people chasing it, and the value gap disappeared. And in private equity, really the glory days of private equity were 20 years ago, and since then, there's so much money chasing a few deals. Is that your experience to date as well? Are you kind of seeing that? And then where are you seeing the smart money going now? Do you see any kind of trends that are replacing that?
Okay, it's a tough time to be speaking of trends because I think we are in the cusp, as Ray Dalio describes it, of a regime change as far as markets are concerned, which come, according to him, in 10-year cycles. I think we're at the cusp of that one. So I'll leave that aside for the moment. I'll start with the alpha question. Mm-hmm. You're right. Everybody wants alpha. Everybody wants to outperform the market. If my client has a quantified rate of return, my alpha over some market benchmark really doesn't matter. All that matters is that I meet his required rate of return year in and year out. However, having said that, I'm sort of going to paraphrase a very smart guy, John Rogers, who used to be president of the CFA Institute. And he said, I know two things about alpha. He said, number one, it is rare. Like everybody knows that most people will not outperform the benchmark. For various reasons, which we're not going to get into. So number one, it's rare. And whatever alpha was out there in the public space had long ago gone over into the private space. They've left their funds, they've left their publicly managed funds and gone into hedge funds and private equity, and that's where they still are. It's more rewarding for it. So it's rare and it's often not there because they're not doing it anymore. The other thing that he knew about alpha, it's darn expensive. It is very expensive. So if you find the alpha, they're often in the hedge fund side or in the private equity side, charging 2 and 20. And that's quite steep for a lot of investors. It certainly made a lot of rich hedge fund managers and damn good for them. And we still see them to this day doing it year in, year out. But we have to remember that there's a survivorship bias there as well. I mean, a lot of hedge funds have failed in the interim, and they don't get counted in the statistics. And then he went on to say, but I know two things about beta. Beta, which is the market return, which is sort of what ETFs are trying to do with their passive investment style. Number one, it is common. And, you can find it anywhere. It's available to the public. And number two, it's cheap. In theory, it's free, but obviously in practice, it's not. You can always help practically most investors. Again, if they start off with a paradigm of, I have this lump sum of money and I want to do something with it because I want to do something else with it. I'm not there to grow the money just for its own sake. I'm there because I want to raise money for my foundation or make sure that my family maintains its lifestyle. Coming from there, you can always use just beta to accomplish all of that for most investors. Now, this has given rise, of course, to the biggest trend of the last 10 years, I think, which is passive investment. Well and good, it has brought investment down to a very affordable way for a lot of investors, and it has worked. I mean, beta works. Obviously, 95% of the time it will work. And there are times like today that it really works against all of us because these ETFs are forced sellers and they feed on the selling, it just feeds on itself, and it just accelerates the downturn. So just as an aside, I mean, there's nothing surprising about a 25% correction, right? I mean, nothing should shock you and me who've been around a while. But what could shock people, and what certainly surprised me, was the speed at which it happened. Right. Clearly faster than '08. Faster than the Asian financial crisis. And I attribute that, a lot of it, to the passive investment phenomenon. It's just a dominant model right now in public equity.